All right, Gary and Kylie, thank you guys so much for being here. Welcome to the show. Let's kick off with some quick introductions before we get into our topic. Gary, you're a return guest here on the show, but Kylie, this is the first time we're having the privilege chatting with you. Do you guys mind just giving a quick intro, who you are, and why you're here to talk about charter school health insurance? Kylie, you want to kick us off?
Sure. Yeah. Thanks for having me. I'm really excited to be here. My name is Kylie Hunter. I work for Berkley Accident and Health. We are a stop loss carrier specializing in group captives. And so we partner really closely with Gary and the Hub team on a captive product specific to charter schools. So, really excited to be here.
And I am also excited to be here, Daniel. I am Gary Clark. I am the employee benefit K-12 national segment leader for Hub International. Launched the Hub Charter segment of Hub International back in 2008. And we are here to talk a little bit about the problem that is health insurance.
Okay, perfect. So Kylie mentioned that Berkeley specializes in supporting captives. If you're wondering what the heck is a captive, we're going to get into that a little bit. And excited to talk about some of the data we're seeing coming out of the Hub Charter Captive, which is a product our team has supported for a number of years now, going back to its inception. But the reason I'm excited for the conversation is because, frankly, it feels like almost every school we sit down and chat with is just wrestling with a pretty brutal renewal cycle in terms of health insurance costs going up. And, health insurance is a top three budget line item, for most schools. And it seems to be accelerating much faster than per pupil revenue or other funding sources. And so I think it's important to have conversations about what's working and how our schools are trying to proactively manage costs instead of sort of reactively, accepting big increases. So Gary, why don't we start with you just on the healthcare cost front? Set the stage for us a little bit. A lot of schools have seen really tough renewal notices. What are the numbers looking like right now? How does that compare to a typical year? Maybe give us a quick state of things before we dive in further.
Yes. The state of health insurance in 2026, I would characterize as dumpster fire. I've been doing this for 25 years for Hub. These are the highest increases I've ever seen come out in a single year for employers across the board. I think that we're estimating, in general, the increases seem to be 10 to 15% higher than they would be in a normal year. And we'll get into a little bit about why that is. But I would say in general, trend, which is medical inflation in normal years, is maybe around 8%. But we've had carriers tell us this year for 2026, when they do their renewals, they're using 15 or 16%. So right there is a doubling of the foundation of where renewals are based on. So there is something going on in the market this year, and we think we have a couple of ideas why, but that's the kind of state of the health insurance industry right now. Ugly.
Okay, so if you're listening to this and you've got a huge renewal, take heart in the fact that you're not alone. It sounds like this is widespread across the industry. Unpack for us a little bit some of the things that might be contributing to this. You mentioned, you guys have a few ideas as to why that is the case, but like what actually functionally happens behind the scenes where, whether it's providers or carriers or employers, where this cost is rising, to that degree, a doubling in a single year. What's going on behind the scenes that actually influences the costs of delivering healthcare?
Yeah, well, it's of course multifaceted, but I think that at the you know what? I brought my own slides, Daniel, so I can share
Perfect.
something
Yeah, give us a visual, and if you're just listening on audio, we'll put this We'll put this in the show notes.
Yeah. So, in general, what we've seen, this isn't the first year that people have ever complained about health insurance increases. It's always been brutal. It's just that in 2026, it's extra brutal. But what we've seen historically is a gradual increase. And what I'm showing here is the number of $1 million claimants that the insurance industry is seeing on an annual basis. And you can see this shows the number of members per million members of covered employees, but the number of $1 million claimants is increasing at 15% on average every year. And the thing about that is that I don't think Americans are necessarily getting sicker. I think that there are constant pressures that drive up the cost of health insurance in the employer market that we can talk a little bit about. But this is what is going on behind the scenes, aside from the funkiness that is impacting 2026.
Okay, so we've got $1 million claimants rising. What about things like inflation? Are carriers, repricing the cost of goods and services?
Yeah.
How does that impact this as well?
Well, in that, there's always pressure there, and there's always salary increases that hospitals have to deal with and the like. But something interesting that we've been tracking is what happened in 2022 and 2023. There was really high inflation in the general economy. I think it was maybe 10%, something like that.
Sure, this is the COVID, post-COVID
That's
kind of
exactly
global
right.
supply
That's
chain. Yep,
exactly
yep.
right. And so what we're showing up on the screen is a year by year annual CPI, the consumer price index that shows the rise of prices. The thing about health insurance is you can't just change the sticker price of an MRI because your costs go up. You have to wait until the renewal that you have with the insurance carrier comes up, and then you negotiate a higher price. So I think the reason why we're seeing higher health insurance increases now is largely fueled by that lag where it takes time for that higher inflation of the general economy to work its way into the health insurance contracts. So it kind of looks something like this. The If the healthcare providers experience heavy inflation in business costs back in 21 and 22, then they come to the negotiating table with the insurance carriers when the renewal comes up, like 24 or 25. I'm talking about their renewal with their contracts between the healthcare providers and the insurance companies. They go in, and the honest truth is the carriers don't have a huge amount of leverage in these negotiations. They need the hospital groups in their networks. They need to be able to cover certain prescription drugs. And so they don't bring a lot of heft to those talks. And what ends up happening is the insurance companies pass on those higher contracts to their clients, and they add their profit margin to it and present a higher increase for 26, maybe even now we're talking about 27. That comes through as higher costs for the employer to maintain what they're doing.
Got it. And so, Kylie, I want to go to you next. I'm curious from, broadly from the Berkeley perspective or what you all are seeing. I know we haven't gotten quite into captives yet, but just from maybe from a risk standpoint or from, stop loss perspective, what are you all seeing from your lens? Is it changing the way your business has to operate as costs get higher? Any thoughts just on sort of the state of the market?
Yeah, absolutely. So to Gary's point, the frequency of $1 million claims is on the rise. A big factor of that is these new medications that are being approved all the time. And as wonderful as those medications are, and some of them are life saving, they come with a tremendous price tag. So I mean, even some of the drugs that you see commercials for, everything's happy and joyful on that commercial. You have no idea that those actually are $1 million drugs being advertised. So it's really interesting in that regard. From an insurer perspective, because of that pressure of the claims costs, loss ratios are on the rise. And just for everyone's knowledge here, the target loss ratio for an insurance company is typically somewhere between 76-79%. And then, the rest goes to cover overhead. And we're seeing the 2025 loss ratios come in around 91% for the industry. So,
Wow.
insurance companies really aren't making that much money right now in the state of things. So that's being reflected in the renewals.
Yeah, I think it's interesting to bring in that lens because, it, your average person, and I'm going to put myself in this bucket as the average person. It's easy to just say, well, everyone's making tons of money and they're just passing all the costs on to consumers. And I think, at times perhaps that's been true in different pockets of the industry. And so I think that's why people do have some of that sentiment. But it's interesting to see behind the curtain a little bit on what are the actual loss ratios, what are the hard costs of providing some of these really innovative drugs. So let's talk a little bit about what schools can do about this. This is sort of the whole point of us getting into the state of things is, are there options to manage this more strategically? I want to frame up sort of the nature of these cost increases. And Gary, maybe you can explain this for us a little bit. So, if a charter school gets a 15% renewal, I think a lot of the time, or a 30% renewal, I think a lot of the time the school feels like, well, I don't really know if that accurately reflects the cost of providing healthcare to our employee population, and it feels a little bit like a black box. Like, what's actually going on underneath the surface? And maybe explain for us a little bit the difference between being in a fully insured plan versus a self-funded plan and how that impacts, the costs of actually providing care to the employees.
Sure. So I think it's going to depend if they get a 15% increase or a 30% increase. A lot of it depends on whether the group is large enough that their claims are driving their renewal. But in general, I think that is it reflective of the care? I think that it's getting more and more distorted because there are some interesting things that go on behind the scenes for healthcare. Let me give you an example. So, if we are asking a pretty simple question, how much does an MRI cost? It turns out that the answer is it depends on who's paying for it. And I'm not going to go through all of these lines, but you can see that depending on who and how the payment is coming, the most expensive MRI is the one that the employer pays through their insurance contracts. And that shouldn't make any sense to the audience because the entire reason why we use these insurance networks is to get us a good deal. But when we go in and do the research in the industry, you can go down the street and pay cash for an MRI at an outpatient facility for 20% of what the insurance carrier pays for the same procedure. So the question that I think we should be asking ourselves is when we use a traditional contract, why is it we're paying the most? And there's not really any national governance on what the providers charge. Private carriers have been subsidizing public provided subsidy programs for a long time. And there's little, like I said earlier, there's little negotiating leverage that the insurance carriers have with the hospitals. And so what we need to do is be asking ourselves not necessarily whether it's reflective but why is the cost so high in the traditional health insurance structure that everybody's using?
So the traditional structure most people are using would just be a fully insured plan. And what you're saying is under that fully insured plan, going and getting using your MRI example, at a hospital in the network is actually going to be the most expensive option in terms of the actual cost of care. And so it begs the question, why the
That's
heck is that?
exactly right.
Is that the case? So let's actually talk about the alternative, which is being inside of a self-funded plan. Gary, maybe tell us a little bit about some of the flexibility a self-funded plan provides, and then Kylie, maybe you can explain just kind of 101 what a captive is. Let's do self-funding first, and then we'll talk about captives and why there's some benefits of captives if you're going to be self-funded.
Sure. Well, I think an easy way to explain it is that there's a spectrum of structures, financial structures that you can use to provide health insurance to your employees. Employers have different choices. Generally, the easy button is to choose a fully insured or some type of partially self-funded plan, and you can see some of the characteristics I'm showing up here on the slide. Sorry if you're just listening, I'm not going to read all these bullet points, but you can kind of see the control that the insurance carrier has over the structure. They control what is going to be covered. They control how the services are going to be received. Through the confidential contracts that they have with their hospitals, they're going to determine what's going to be paid to the healthcare provider for that. And there just isn't a lot of flexibility or control that allows employers to do what they need to manage health insurance costs. So the next step, or what's becoming more and more popular, is self-funding. And quite simply, what it gives you is the freedom and the control and the transparency to be able to run your plan. So you get an opportunity to build it the way that you like, to cover the things that you want, to pay for services the way that you choose. There are just several different benefits to being in a self-funded structure that employers are starting to realize more and more.
Got it. And so fully insured, less flexibility, self-funded, more flexibility. You can start to think about how to manage those claims. Kylie, explain to us what a captive is and why are people drawn to a captive structure? Like what normally piques someone's interest in a captive, and why are captives often looked at for if you're going to go self-funded?
Sure. Yeah. So, I mean, smaller or mid-size employers who are choosing to go self-funded, they need protection from high dollar claims. So you've got to purchase the stop loss protection. Captives are really an alternative risk financing structure for the stop loss protection. So it's kind of a subset of your stop loss protection. And there are many different captives out in the market. Each one is structured very differently. So, for anyone who has already heard the term captive when it comes to stop loss coverage, what I would say is, the hub charter captive is probably structured differently than any others that you've heard of. So, come into it with an open mind. The real draws are a level of transparency. With captives, you really get to see where the dollars are going. I guess backing up a little bit, the purpose of a captive is to share an additional layer of risk amongst a pool of employers, a pool of charter schools in this situation, that normally, they can't take on themselves. So they're banding together, they're sharing an additional layer of risk, which in turn means that they're collectively purchasing less insurance from the carrier, which comes with advantages. And we'll talk through some more of those advantages as we go. But yeah, transparency, opportunity for surplus, and more favorable renewals are kind of a sneak peek into the benefits.
So just to play this back, if I'm the CFO or the executive director at a school that has 85 employees or 125 employees, and I'm thinking, oh, this could be interesting to go self-funded, we get more flexibility, but then I hear you saying there's more million-dollar claimants than ever, there's all these new drugs rolling off the conveyor belt. And if we have one of those, essentially our school is screwed. We're insolvent. And this is why we purchase our fully insured product. And so what you're describing is the captive opens up this concept of pooled risk, and then stop loss insurance is what protects you against the downside of, God forbid, one of your employees has a terrible, claim, or a really serious health issue that puts them in that really expensive category. That's how you protect your organization if you're smaller on the size. And is that a fair summary? Did I capture
Yep.
that?
Yep, that's correct. And one thing that I would say, stop loss is meant to be a protection for your maximum exposure, both on individual claimants on the health plan, but also for the aggregate claims that your whole population is incurring. So there's two levels of protection, and then the captive is just a unique way to fund that stop loss coverage.
Got it. Okay, so let's get into the hub charter captive because, Kylie, you mentioned lots of people are familiar with the term captive. It gets thrown around sometimes. Maybe people have done their research online. Maybe you've looked at a captive product. Maybe you have a broker who's tried to talk to you about a captive product. But you mentioned they're all structured differently and there's lots of nuance to them. And so, Gary, maybe give us the quick high level on why you guys started a charter school captive specifically. And then maybe let's fast forward a little bit and see, because I know this has been in the market for a number of years now. Give us a sneak peek on some of the data that's coming out of the captive before we get into some of the mechanics. Let's paint the picture of the benefits of the captive before we get into some of the mechanics. But let's go back to why found this in the first place, and then how's the captive structured specifically for charter schools?
Yeah. And this is kind of a fun story to tell. So happy to tell it. We about 17 years ago, 18 years ago, we started our hub charter practice and started educating charter schools about partial self-funding. They weren't really large enough to go self-funded on their own, but groups like Cigna, Anthem, United Healthcare, they offer these partial self-funded programs that were better than being fully insured. But what we did was we looked at how much the charter schools were paying the insurance company for stop loss coverage and how much the insurance company was paying out in claims. And the insurance companies were making a lot of money. And we believe it's because the demographics, and this, we've actually seen this over the last 7 years, is that the demographics of charter schools are simply better than the general population. And so when we can insulate charter school risk from any other risk, which is what we do in the captive, we win. And we've seen that historically. So that is the reason why we saw that the charter schools were overpaying for stop loss in the partially self-funded products. We thought that they could do better by reducing the cost of their stop loss like you can in a captive. And these are the results. We've seen since 2019, on average, that the charter schools have achieved between 22 and 26% savings relative to the old program that they were on. We kind of mapped this forward with their old program. This is everybody. And in blue, we're showing what the actual expense was for the charter schools collectively in the captive. And so we've got some summary data here, but well north of 20% reduction in health insurance cost, an estimated savings across the members of $7.83 million. And I would say that the success of this is really just insulating ourselves from the normal health insurance market. But the beauty of self-funding is to be able to put claim management tools in place that can actually reduce what you spend for that MRI we were talking about. And several of the charter schools have taken those steps and have had even greater success. But this is a summary of how it did relative to its old program. I will throw it over to Kylie to talk a little bit about how Hub Charter stacks up in regard to the general stop loss market and some of their other captives.
Yeah. So we really have seen that the hub charter groups have performed better than all of our benchmarks. So this slide, I'll just quickly go through it here, is an illustration of Berkeley's own portfolio. The top line is average rate increases for traditional stop loss business that is not part of a captive. And those increases average 17%, with about a quarter of those renewal increases being above the 20% mark. Looking at our entire portfolio of captive programs, which is around 50 different programs in our under our umbrella, those increases are much lower at 10.2% on average. And that 20% increase or more is really reduced. I don't know the proportion there, but I would say maybe around the 10-15% mark. And then looking at the third line here is specific to the hub charter captive. And those increases on average are 8.2%, with just a sliver being above the 20% mark. So these results are really amazing and something to definitely hang our hats on. The charter captive has been in motion for several years now, so these are reliable results that we can speak to. And going back to Gary's point, the charter schools are a more favorable demographic. We see them performing better. So pulling them out of a general risk pool, whether that is a stop loss insurer's general pool, a general pool of a heterogeneous captive full of all different industries, pulling them out and creating a captive just for that industry has been great for them. They're really seeing the benefits of being part of the captive.
Got it. So just to play that back, instead of like any charter school could go join a captive hypothetically, but they in theory could be joining a captive where there's companies from all sorts of, walks of life, industries, etc. And so that overall demographic population may or may not be favorable to them in terms of the actual claims that they're bringing into the pool, whereas charter schools, when separated out and put together, they're a more favorable demographic, and that could be slightly younger population, maybe different dynamics, maybe less cost of healthcare for whatever reason, and so it works in their advantage to participate together in a captive as opposed to just going to a more generic sort of off the shelf captive structure.
Exactly. Yep.
Okay. So why don't we do this? Let's do some rapid fire questions because I know we're running out of time here. And I want to hit on some things that are probably questions that come to mind for school leaders that might be listening to this. So I'm going to be our kind of devil's advocate or misconceptions asker. And we'll just run through 4 or 5 of these before we wrap up. So I think probably the biggest one, and Kylie, maybe we can start with you. And I know you've hit on this a lot, but is just this is too risky. Like we're putting our organization in a risky position. We're public, fiduciaries, taxpayer dollars. We can't put ourselves in this position. And I think boards sometimes feel this way, but oftentimes the CFO feels pressure around, taking on additional risk. What's the like 30-second answer to this in terms of, maximum liability, total exposure that most people get wrong?
Sure, absolutely. So, there is risk involved when it comes to self-insuring your health plan, but that is where stop loss coverage comes into play to define your maximum liability. You are going to pay a premium for that, of course, but you are going to have that certainty that your claims exposure will not exceed X. So having stop loss is the fundamental key when going self-funded. Beyond that, I would say going self-funded provides a lot of control over your health plan spend that doesn't exist in a fully insured or bundled arrangement with an ASO carrier like a Cigna, Aetna, whoever. So there is control over directing care to providers that, provide good costs or favorable costs. There are so many levers to pull. So you can really get a hold over your risk versus just accepting that 15-20% increase year over year.
Right, that's
And
sort of the inverse. The
right.
inverse risk is you just get 20% year over year compounding in perpetuity.
Exactly, exactly. And that's not a risk that many employers can take anymore, right? So they've got to take control over the spend. From a captive perspective, I would say the one objection that we get most often is okay, we're taking another layer of risk. What does that look like? And what does that cost, right? There is a risk component involved in a captive that we can dive into hopefully in a 201 session here. But the thing to remember is the risk is defined. Your maximum liability, whether you're in a captive or a traditional stop loss arrangement, is clearly defined for you from the get-go.
Got it. Okay, perfect. So max liability is defined. That's something you can slide up or down in terms of your level of risk and comfortability there. Gary, let me go to you for this next one. I think another really common question is just what happens to our current employee benefits if we change this? Are they going to get I think people automatically assume worse care if costs are coming down. Do we have to change our network and our providers and all those good things? What's the actual answer to that? How much change is involved? What are the situations that drive change on the actual employee benefits side?
Yeah, that's a great question. I think from the employee point of view, they might have to have a network change depending on where they are right now and what networks are available. But really, everything else looks the same to an employee. The plan designs don't have to change. It's possible that maybe their copays might change for their drugs because we may put it on a different platform. But the health insurance is pretty easy. The federal government has said that anything that's medically necessary needs to be covered. And so the platform doesn't take away benefits from employees. I think it actually provides options for alternate types of care that can provide them a better experience when they're going in for a surgery, for example, or provide them cost savings by reducing the cost of the service that's being received. So we haven't had any experiences moving charter schools into captives where the employees were necessarily disrupted. I think that for the administrators, one of the things they need to understand is when you design a self-funded program, you set it up to run all year long on its own. So there isn't daily stuff, there isn't weekly stuff that a HR team or a finance manager has to do because at renewal time, we have a strategic discussion about what we want to do to help the plan run better. We put those things in place at renewal time, but then it just runs for the year. So there might be an extra 30 minutes a month that you might spend reviewing the claims reporting that you now have access to see how things are going. But there is not a heavy lift. I think that primarily the experience is that it's a more strategic discussion at renewal time, a very intentional with specific goals towards the long-term strategy. But once you set it up, unless something breaks, which things break all the time in the fully insured structure too, then we respond to it. But it isn't something that requires weekly hours from the organization to manage.
All right, last question. Who's not a good fit? Like I think sometimes people, want to know what's the profile of an organization that you would steer away from this and why? Any thoughts there, Kylie or Gary?
I would say, first of all, really small schools, less than 50 employees, we don't typically recommend that those size of schools go self-funded. So if you fall in that category, there can be flexibility, but I would almost recommend against it. And then, schools that are for whatever reason, running at a very high loss ratio currently. It's all about timing, making sure that you're going self funded at a good time. It's hard to know when that is, but that's something that through the underwriting process, we at Berkley can help with. And I would say too, while Gary says, it's not a huge administrative lift or anything like that, we're really wanting to partner with employers that have a long-term vision and want to take control of their health plan spend. So if you've got more of a set it and forget it mentality, self-funding and captives might not be the right fit for you.
All right. I love that. Gary, anything to add to that before we wrap?
No, I think that was really good.
Perfect. So I think just, as we come to a close, I would double down on what Kylie said, which is, the reason we are passionate about this topic is because we want people to take a proactive and strategic approach to this. I think the challenge to the audience would be if you're taking a set it and forget it approach to your third largest budget item, that's probably not wise. And there's an opportunity to think more strategically about it. And that starts by getting into the data, understanding the claims of your population. What are the other structures that might be beneficial, and exploring things proactively. I think one of the biggest challenges is people wait till renewal time and then it's often too late. And so the time to start working on this is now. It's kind of the classic best time to plant a tree was 20 years ago. Second best time is now. So
Yeah.
that's our encouragement. If you found this interesting and you'd like to connect with Gary or Kylie, we'll put their contact info in the show notes. Feel free to reach out to me. You all know BuyQ and Hub have worked together for a long time in this space, and we're passionate about trying to help schools manage this cost bucket. So hope you all found this interesting and insightful. And until next time, thank you, Gary and Kylie.
Thanks, Daniel.
Thank you, Daniel.
Kylie.
Thank you.
Thanks for listening to Charter School Insider. This show is brought to you by BuyQ, the group purchasing organization specifically for charter schools. Want to learn how to maximize your school's purchasing power? Join together with thousands of other charter schools by visiting buyq.org/sign-up. BuyQ's purchasing program is free and has no obligations or commitments required. If you enjoyed today's episode, do us a favor and subscribe on your podcast listening platform of choice. If you have a question or feedback for us, we'd love to hear from you. Send us an email at podcast@buyq.org. Thanks, and we hope you'll tune in for the next one.